20 years, you will see that. And from that 1 CR to 2 CR and all, it takes very less time. Because the power of compounding comes into picture. Okay, so we'll start with that. I will start with the quote. So, from Warren Buffett, yeah.
By the end of this session, you guys will ensure that we are financially free right here.
Yes. Most of the topics you might be already knowing, but we spend time on multiple things, but we don't never feel that finance is our requirement and it's necessity. We never spend 15-minute or 30-minute time to take a notebook and note down what is my goal, what I need to do in 2 years, what is 5 years, what my kids need to do. And we, most of the members, I think, from the IT background, we don't have any pension or something. And considering the current situation, kids and everything, we should be financially independent. Either it's a girl or woman who is working. It's needed for everyone to be financially independent. It's not necessary that you should not contribute with husband or pay the loans. Or it's a family, but at least for our financial needs, we should not go every time. Okay, I need a money. It's possible with just small habit change. Okay. So I will start with the Warren Buffett. I think everyone might be aware, especially about the stock market, guys. So never depends on single income. Make an investment to create a second income source. So there are multiple ways. If you invest, suppose in the stock market, you will get a dividend. You will keep on getting if you do the FD or some rental income. So that is also the passive income. So I am going to cover the few topics, especially about how we can do the investment. We have Atul, who is expert in finance. He is chartered accountant by profession. He is I think, will answer all of your queries if I am not able to answer. So he will cover specifically the investment topic, mostly on the equities, mutual fund and all PMS and all, how we can go to the next level. My session may be the basics for you, but our expectation from this session is, most of the members might be already in the investment or started the investment and doing that. Just follow it for longer. Think long term. Don't just start your SIP and keep checking your portfolio. No. Mutual fund, suppose you start, it's for the 10 years, 15 years. Keep the plan. Suppose my kid is going to be 12 after 10 years. I will put some SIP for his name. I need to buy something. I need to buy personally the car which is 15 lakhs rupees. How I can achieve that 8 lakhs rupees after 4 years or 3 years? It's possible. So just start and invest and look for the long term. It's possible that your requirement is short term for few. Suppose after 2 years you need a money. So no, not necessarily you should be invested in the mutual fund for that. There are multiple other sources. It can be FD, it can be in the government bonds, or if the members who is doing the job, they can invest in VPF. That is the best thing, I feel. Because we don't even know that it's in our account and the money is getting accumulated, compounded, and every year we get the interest. So we'll do that. So the first, okay, I will start that. So first important thing is that, as I told, set clear financial goals. Really, I feel, I am in the IT for last 20 years, around 19 years. I feel we earn. The main purpose of doing the job in the Bangalore and staying here is money. Money is the major part, right? But we never pay attention. We take the home loan. I think, who all are having the home loans here? Maximum members are having home loan. Do we really track how much is my interest? Do we really track how much my principal gone, interest gone? No. We take a loan, we pay the EMI and we forget. And then we say the Kolte Patil Mirabilis 2 BHK became 1.2 CR. Okay, we took house in 60-65 lakhs. We took 50 lakhs loan. But till now, suppose 8 years or 10 years, and after completion of 15 years, we are already paying 90 lakhs interest. So if you consider that, we are at break even. It's our money, our hard-earned money. So how you can make it better? So set clear financial goals means take your time, today or tomorrow. Just spend your 30 minutes of your personal time. It's for you, not for your family also. Take your time, note down what I think, what all things I have, currently what all investment I am doing, or suppose any plot or what I need to buy. Short term, mid term and long term. Long term specifically for us, IT professional is, what is my retirement plan? Do I need to depend on my kid when he will go to the job and he will give us the money? No. We should, whatever our requirement, we know that currently I need a 50,000 rupees per month for myself. So I know that after retirement I need at least 1.5 rupees. So how I can make that arrangement now? So when I will be 55, 58 and I decided I need to retire, how I can get that passive income so I don't have to depend on anyone. So what all things we can do? So set your financial goals, note it down. It's not necessary that you should be expert in noting down. Just write in your own language, what is my requirement. Suppose I have to give something education. My kid wants to do MBBS. So currently MBBS we feel that it's far away from our reach. But why to stop him? If his interest is that, let him go. You can plan your 12 years, 10 years. You can prepare yourself to get a 50 lakh rupees. Maybe the half part he can do the educational loan. It's his responsibility also. But don't stop. Plan your thing, and I am sure that I might have realized late, maybe 8, 9 years or 10 years. I feel it's late. That's why as a social cause, we try, especially the juniors who come from the colleges and all, they don't even care. But we still try to take a session as a responsibility. If out of that 10% members start doing something, I tell them just start 1,000 rupees in your VPF. Just send one simple email to HR that I need to contribute more from my side in the PF. And every year increase 500 rupees. Don't worry about that money. After 20 years, if you don't have 1 CR, tell me. You will be very happy to call me and tell me that okay, amount. In PF only I have 2 CR rupees. In mutual fund I started 1,000 rupees and I increase every year, and how it became. So it's a power of compounding. I will explain that later. So first thing you can do is write down your financial goals. What is your requirement? How we can do that? It automatically happens. Most of the time in any session or something, we feel very good. Okay, I will do that now. In office also multiple sessions happens on the finance. But after 2 days or 3 days we forget, and we never feel that is important. Don't do that. Starting is very important. You start with 1,000 rupees. Don't think about 10,000 or 50,000 I need to put from the day one. It's not possible. It might be possible if you are earning 10 lakhs rupees per month. Don't worry about that. Just start. Starting is very important. Then automatically every year you can increase and make it bigger. When it will become too big, you will also not realize. Let it be 10 years or 15 years. You will see CR. For us, middle class family who came from villages like me, CR, I never feel that I can have 1 CR. But I am telling from experience, or we have few experts, Atul and all, where it's really possible. So start something. This is very important topic which I already talked few things, but I will go in little detail. We normally prefer to take a loan. I know that house we cannot buy in Bangalore without housing loan. Okay, that is necessity. I am not telling we should not have housing loan. But our money we should keep a track. The bank is ready to give you 25 years, 20 years, 10 years. But how much money we are paying? I will explain you one Excel sheet is there. If you go on I will share that Excel sheet also. Otherwise, simply on the Google go that max gain sheet. Team BHP one sheet is there, or SBI is also having this max gain plans. It's nothing but it will make you realize if at the starting 5-6 years how much interest is going. Bank is taking almost interest in the first 4-5 years, 6 years. And your principal, suppose you have taken a loan of 50,000, I will give the example. 50 lakhs rupees, you are paying 50,000 EMI. From that 50,000 EMI, only 10,000 is going as a principal, 40,000 is going as an interest. We don't care. Our office asks on January, give me housing loan statement. I will go to bank, I will take the statement, next day I will forget. That day I will feel sad. Okay, I paid 4 lakhs rupees interest and only 1.5 rupees interest. But after March or April, okay, let EMI go, I will enjoy. I am not telling you should not enjoy. You should enjoy, you should have your priorities. But these things are important. If you, at the starting, if you make a small payment extra, it might be your 5,000 or 10,000 or you got a bonus in the March end. Just pay that 50,000 rupees. Don't put full bonus. You can go out of India or anywhere, but put that 50,000 rupees. At the starting, whatever payments you will do, that will make a huge difference. I will show with example. If you make 1 lakh rupees, that might save your 4 lakh rupees interest. But if you make the same payment after 5 years or 6 years, it can make only 1.5 lakh rupees saving for your interest. So how you can make that difference? If you have the EMI of 45,000, let's make it 50,000 from the start. increase it to 55,000. How much difference it can make, you will not realize. Your tenure from 20 years will come to 18, 17, 16, 20 years. And it's your money only. You will save interest. So keep your target. Suppose Mirabilis started, most of us booked 4 years or 5 years back, and work was going on. So suppose if we might have kept the target, when I move to the Mirabilis, I don't want any loan. My loan should be clear. So automatically, in place of paying 50 lakhs interest, you might have paid 20 lakhs or 18 lakhs. It's your money saved. So how you can do that? And now the personal loans. Especially we get multiple calls, and sometimes we will be really in emergency situation that I don't have choice, I need to take. Keep a track. Avoid the personal loans because that interest rate is too high, 13-14%. Especially the credit cards. Young graduates, Dada's son is there. I'm just giving you an example. But now bank is really interested. They will call, HDFC will call, Amol, there is a gold card for you and all benefits. Then ICICI will call, and I feel proud. I have 10 credit cards. And we swipe it. At one situation, we go in the trap. If we use the credit card well, if one credit card you use well, you pay on 52 days or 50 days time, then it's good. But sometimes our expenses become more than what we have. Then we convert to the EMI. Credit card, they are very happy because they will get that interest 1.5%, 2% per month. So you will pay 25-30% in interest. So don't go in that trap. Credit card, make it little usage less. It's better. So who will say something? I am earning 1 lakh rupees. Why I need to spend 1.5 lakh rupees, which is not my money. One day it will trouble me only. So let's keep your things little bit as per your requirement and all. That's why credit card usage. Don't avoid credit card, but just do analysis. Is it really needed? 4 credit cards, 5 credit cards. What is the purpose? Flight. How many times you go to your native? 2 times. My friends are there. Like Atul. I will ask him, Atul, can you have the credit card? Can you give me? It's okay. Pay him immediately the cash. You will get 1,000 rupees, some cash back or something. Why to have 10 credit cards and pay the cycle and all? So just analyze that. So Atul, one Excel I need to open. I just need to show. When you come on. Downloads, it's there.
One question on the credit cards.
Yeah.
Generally, people use credit cards to improve the credit score. Right. So, is there any other way we can actually improve the credit score?
No, there are multiple ways. If you home loan only, suppose if you have 1 CR loan and you took the tenure of 20 years and you are able to finish in 7 years, that is also your credit. You are paying it more. For me, suppose, just to give an example, I was having credit card maybe in 2008, 2009. After that, I don't have credit card. Now I am buying one. But I never felt it's needed, and my credit score is still more than 800. It's not necessary that it became 600 and I will not get any loan. Why? It depends on your income and how you pay your home loans and all. There are other ways also. Yes, credit card contributes to your points. That's why don't go in that EMI option in the credit card and take from other credit card, pay that. There are so many ideas. If you see the youngsters, so many ideas are there. Yeah. Not coming there. Okay, anyway. I will share that max gain sheet, no problem. It's not coming. So it gives us, it's really interesting. If anyone is buying the home loan or already having the home loan and needs some guidance about this sheet, you can only explore. Put your how much loan you are having, how much interest rate you are having, how much your tenure. It shows you how much is the principal, how much is the interest and all. And at the starting, if you make the difference, suppose Atul, just help me one thing only. Here, suppose the loan is 25 lakh rupees, 9% interest for 15 years only. So we are paying 21 lakhs, 20.64 lakhs as the interest extra. Okay? Just add here 1 lakh rupees or 50,000 rupees, Atul. First deposit, anywhere. So that 1 lakh rupees payment I did because I got a bonus. It's around my tenure reduced by 1.2 years and the interest reduced by 2.5, 2.6 lakhs. It's a 15 years, but if you see 20-25 years loan normally we take. So same 1 lakh you do control X and put it down after 5 years. No, just remove that and continue.
The first one.
Remove and anyone. And just remove this one also and add in the down after 4 or 5 years.
Here?
Down. After 5 years.
After 5, right? Okay.
No, 5 years.
6
Okay, here also you can see. Once you go down, The main important thing to see here is your principal and your interest. See the difference. You are paying 19,000 as a interest and 6,000 as a principal. So bank will take down all the easy interest from in the 5-6 years only. So later I realize I moved to Kolte Patil, now I have the money, I will pay. That will not make a big difference. But it's always better, especially the guys like me or the other who is 40-45 range or more. No need to keep multiple loans on your head. It's a debt only. So try to clear your loans as early as possible, especially the home loans or something. It's better in 45. I don't have the loan and I am living my life happily. I am getting the money, how I can do the investment. Okay.
After 5 years.
Yeah. After 5 years, suppose he added. Previously it was making 2.6 lakh rupees difference, right? 262. Now just 96,000. Here also it was 1. So just make, here if you do in place of 25,000 rupees EMI, if you just make 30,000 rupees EMI every month, just 5,000 extra, your tenure will reduce, your interest will reduce. So just go through this sheet, whoever is having home loan, it just need 5 minutes. Spend your time, it will make you realize what it makes the difference here.
So now we have already we have our home loans for almost 7-8 years now.
Yeah.
So we are past that period. So now if we increase, will that make any difference?
No, it will surely make a difference, I am not telling, but the same difference it will not make. But at least you should be continuously tracking what is my interest rate currently going on. Because when bank will increase, they don't even tell you. If there is some scheme or something, pay 1100 rupees or LIC 1500 rupees and they will reduce. So keep a track on that. Go there. Sometimes LIC and all, it's not online. So go there, pay that 14,000 rupees, 1400 rupees check. Your interest will reduce. You will save your interest, big interest. So keep a track of that and keep track of your home loan. If you make a payment also good. Who don't want to be that I am the loan free in next few years? Why to keep that headache of 50 lakh rupees till hours 55, 50? And it will, you can think about next home loan also. If you are clear, okay, now I am confident that I paid a 65 lakhs rupees home loan. There is a prestige, something big tower is coming. Suppose he is buying, Ashwin is buying. Ashwin, I am just giving you example. So that is 1.5 years. But you know, okay, I paid 55,000 rupees when my salary was 75,000. Now I am earning well, so I will pay. But keep a track of this. Okay, and then, that's all I think. So next one is the investment. So I will request Atul to go in depth about investment, and I will cover the next part, which is really other important topics. So Atul.
Sure. Thanks, Amol. So first to start, are you able to see this slide? Is it visible? Not visible? Okay.
No problem.
Okay. A quick introduction. My name is Atul. In terms of qualification, I'm a CA and MBA. I've been associated with the investment world for quite a while now. I'm going to talk about investments and how we thought we'll structure this presentation is that while Amol spoke about the financial goal, he mentioned about reduction of debt, which obviously is important. The next logical step for all of us is to how to invest our funds, because most of us do have funds available with us, and as we grow up in the ladder, investment become much more important because we talk about active income, we talk about passive income and so on, right? Making income out of income and so on. So the way I have only one slide which I'm going to cover, and here I have segregated investments based on the risk categories, because that makes utmost sense where we are at our age group or levels right now, because most of us are not the starters in the investment, but most of us are in the mid or semi-mid category where risk factors become more important. Now, before I get into the theoretical part of investment, let's just do a quick round to understand how many of us are investors here. How many of us are aggressive investors? We do invest regularly, we monitor our investment. How many of us are such that right now? But do we track our investments? We do track. How many of us are traders? Do we trade our investments? Do we do very active churning of our investments and so on? Okay. How many of us know our risk profile when we do the investment? As in, when I say risk profile, how many of us, understand what is the amount of risk which different investment carry and based on that we decide our investment type or the category. Okay. So see, I'm not going to talk about in trading now. I'm going to focus on investments, and let's just talk about the low risk. So what I've done is I've categorized into 3 broad categories. Again, this is based on certain parameters. When you talk about low risk, moderate risk, and high risk. First step when we do the investment planning is to understand which risk category we belong to. Because unless we understand our risk profile, we are just doing a random investment without any determination that what sort of return we are going to expect with the amount of risk which it carries, right? Because when we talk about the low risk investment, and I have listed down some of the standard ones, right? We talk about debt funds, there are certain categories where we invest debt funds. You talk about liquid funds, gilt is the government linked securities. You talk about overnight funds. So all of them have fixed coupon rate, which is the fixed interest rate what they carry. You talk about debenture bonds, VPF, which is the voluntary provident fund. We talk about NPS, National Pension Scheme, fixed deposit scheme, and saving bank account schemes. Now, one of the unique quality of all this investment type is that they carry a fixed rate of interest or coupon, what we call. But this is a very standard growth model, right? We are talking about minimum risk with minimum return. So this is ideally for someone who wants a very stable return across. Now, who is very risk averse in the category, who does not want to get involved in the market sentiments because market do ups and downs. There are a lot of things which impact the market. None of them, in general scenario, would impact your return unless something happens from a fiscal policy perspective by government. Otherwise, nothing is going to impact in the return as far as this category is concerned. So, when we talk about a stable investment, any stable investor should keep at least 40 to 50% in the low risk category of investment. Now, this is the general criteria which is followed across. If you want a tension-free approach from your investment, do keep 50% here, and the remaining 50% can be equally segregated between high risk and moderate risk. Now, coming to the moderate risk, and this is where most of us invest. Now, here we talk about mutual funds, we talk about ETFs, there are ULIPs, real estate, agriculture-related investment, and so on. The difference between mutual fund and ETF is very simple. Mutual fund invest in equity, ETF invest in the index itself, right? So if you're not sure about which stock you want to target, whether you're not sure about particular stock will move or not, but you know that country as such will progress, ETF makes more sense. Also, ETF has lower cost as compared to mutual fund. However, mutual fund gives you a benefit of higher return because usually traditionally stocks have given much higher return as compared to indexes. Now this has been a proven fact and statistically well established as well. So when we think about segregating between mutual fund and ETF, if someone is really in a mix, how should I segregate? So make sure that you have 60% exposure in mutual fund and 40% in ETF, or you can do 75-25 as well. ETF also has its own advantages, so I would recommend you to invest in ETF as well. So it's easy to invest in gold ETF, silver ETF. Copper is the new metal which everyone is talking about after gold and silver, right? So you can have copper ETF as well. Although it's not launched in India yet, but you have an NYSE or other stock exchanges if you want an exposure. So ETF gives you the global investment pattern as well as compared to mutual fund, which is more domestically synced. There are certain mutual funds like Parag Parikh and all where you can invest in the global NYSE or NASDAQ and so on, and that has given phenomenal returns as compared to traditional mutual fund. But they have their own share of risk as well, right? So again, it's important to understand. There are various type of mutual funds. Now, if someone wants me to get into the details of any particular, then I can talk about it. But it depends on your exposure to equity, and mutual fund do invest in equity as equity, debt. They also keep a combination of high risk and low risk elements because they are also worried about the market movements and market sentiments. So when someone is talking about a moderate risk profile and someone really wants to invest into mutual fund, which a lot of us do as a part of SIP or structured investment plan and so on, we don't realize that our selection of mutual fund should also be based on our future goals. Now, it also again boils down to what is our objective and what we aim to achieve out of mutual fund. Now, if you're looking at purely from a long-term perspective, then multi-cap or large-cap mutual funds are best for us because they have good exposure to equity and they mostly focus on high capitalized stock or index stocks and so on. When we talk about high risk mutual fund, there are mid cap funds, small cap funds. Traditionally, these mutual funds have very high beta, and beta means your impact, your movement in the mutual fund as compared to the movement in market. So when you have higher beta, that means you're carrying a higher risk from a mutual fund standpoint. So if you need to decide on selection of SIP between the mutual funds, let's just be sure that what type of criteria we are looking at. Now, for example, if someone wants a very stable mutual fund portfolio and you want a risk-free mutual fund portfolio, then make sure that your 75% investment is between large cap and flexi cap and 25% is mid cap and small cap. If you want to take a risk within mutual fund portfolio, then you can do 50% in mid cap, small cap, and 50% can be large cap and flexi cap. If you want to take a very aggressive position from a mutual fund standpoint, you can go up to 75% in mid and small cap, because say last 2 years the market rallied from 22 to 24. Mid cap and small cap have given a CAGR of more than 40%. So this is where the phenomenal return comes when your market supports the economic growth. While large cap and flexi cap would usually give you not more than 20% CAGR on a 5-year plus investment basis, right? So we're talking about 15 to 20% CAGR. Focus on large cap and flexi cap. If you want to take some risk, you want to go with 25-30% of CAGR, go with mid cap and small cap funds from a mutual fund standpoint. And I'm intentionally taking more time here because I know a lot of us are interested in mutual funds. Same ideology work with ETF. There are various types of ETF. You have index stock, you have new age ETF, you have small cap, mid cap, gold ETF, silver ETF, and so on. Every ETF would have its own risk criteria and so on. But the same logic would apply here as well. ULIP is again a unit linked investment plan. I'm not sure if a lot of us are interested in ULIP. But see, one of the unique advantage of ULIP is that it gives you a risk, it gives you a tax-free return. Now, if you're investing up to 2.5 lakh of premium every year, and ULIP is usually long term, so usually people buy ULIP for their kids or for their long term planning. So you talk about 15 to 20 years plus of plan what you've taken. So assuming you have invested 2.5 lakh every year for 20 years, so you're investing a principal of 50 lakhs. That 50 lakh would get invested in a typical mutual fund scheme which will be under the program criteria of ULIP. And that will, suppose with a CAGR of 15%, that 50 lakh will easily turn to 2.5 to 3 CR at a minimum. And that amount will be entirely tax free for now. So government has started taxing it only if your premium is more than 2.5 lakhs. Below 2.5 lakh, it is tax free. So one advantage here is mutual fund is taxable as per the short term and long term capital gain norms. There is no exemption except for 1 lakh of long term capital gain which is there for the stocks. But for ULIP, for now there is no taxation which has been planned by the government. So this is one added advantage what you get in ULIP. Okay, so this is from a moderate risk standpoint. If you want me to talk about anything, I can, but let me just drive down to high risk.
Real estate. Are you talking about real estate or REITs or REITs?
See, REIT is again very similar to how ETF and mutual fund operate.
Okay.
Now, it is from a tool perspective, it will invest only in the real estate assets But from a structuring perspective, it is very similar to how you purchase the units in mutual fund or ETF. So again, it is the segmentation which is different, but the core principle of investment remains the same.
Oh.
But real estate, I was actually talking about a direct real estate investment, which I will not focus upon because we are kind of talking about stock market and securities and so on. Let me cover the high risk items first, and then I'll talk about something else. Now, see, like I said earlier, if you want some stable portfolio and if you want so 50% are investing in low risk, 30% in moderate, and 20% in high risk. If someone really is under an aggressive risk category like I am, so we invest 50% in moderate and 50% in high risk, and that is my risk profile. So that is the model what I traditionally follow. Now, from a high risk perspective, because of the increasing investment dynamics and a lot of people interested in higher return and higher income generation ideology, a lot of new tools have come up from a different investment perspective, right? And let me just cover them one by one. Direct equity investment, all of us understand, derivative is fine, it is extremely risky tool to operate. So there's something called as PMS and AIF which has come up. Again, I'm not sure how many if you're aware of you're invested in that, but see, these are all SEBI-registered portfolio schemes which are there in the market, and anyone who is selling PMS or AIF, they would have a SEBI number attached to it. And this is very similar to the RERA number what we check for an investment for the real estate investment. PMS, the minimum ticket size is 50. For AIF, minimum ticket size is 1 CR. This is the minimum investment we need to give to them. Now, PMS works on so someone professional will manage an investment entirely, and they will work on a profit sharing model. Traditionally, PMS has given much higher return as compared to mutual funds because there are no norms which apply to PMS and AIF. Mutual funds have tons of regulations, they need to maintain certain investment criteria, they cannot do intraday, they cannot do swing trading, they cannot do short-term trading. There are a lot of criteria which mutual funds, and this is for the larger interest of the society. But PMS and AIF does not have any such regulation, they are free to operate the way they want. And in terms of AIF also, there are 3 types of AIFs which are there in the market. And these are all SEBI-registered AIFs, so I'm not creating anything of my own. There's CAT one which only invests in startups and venture funds. This has given the highest alpha in the last 5 years in any investment tool there in India. Most of them have given a CAGR of 50 to 75% over the period of 5 years. So in 5 years, they would have given a 4x return to your, if you invested 1 CR would have easily become 4 CR in last 5 years. But this carries the highest amount of risk which is there in the market. Second risky investment is real estate, and third is equity. Again, real estate, they would only invest in real estate and REIT. This is where the REIT investment comes from. And from an equity standpoint, they will invest in equity and derivatives. So there is no restriction to invest in derivatives here. Mutual funds are not allowed to invest in derivatives at all. Please go ahead.
Yeah. For PMS and AIF require minimum position.
That's right. That's it. Yes. 50 is for PMS and AIF is 1 CR. This is as per the SEBI norms. Yes. And there is no negotiation on that. Again, I just thought I'd give you a glimpse of this. Not sure how many of us are
Maybe I think a few might be already invested. But let's reach to that 1 CR and plus, and then we can think about PMS. That is our next chapter. Okay, I have the money, 50 lakhs. I can go for PMS. But at the starting, maybe this session, if we are thinking to start and I have to reach to 1 CR, starting I also can't think about PMS. But maybe tool is there on the PMS and AIF. But we can reach there. We can keep that track. Okay, I have to reach there to the PMS or AIF. That is my next target.
See, most of this I'm talking about out of my personal experience because I have invested in all these criteria personally. So I have experienced PMS, I have experienced AIF. AIF has given phenomenal returns in last couple of years when market rallied. But when market go in a correction mode, AIF also does correct significantly, right? So we are talking about high beta, high alpha in AIF. PMS is much more stable. If someone is confused between PMS and AIF, PMS is much more stable as compared to AIF. And within AIF as well, CAT 1 is the highest risky AIF and CAT 3 is the least risk out of all them, right? Commodity and metal trading, again, if someone really wants to talk about, I can do that. Crypto, international funds. So there are a lot of options available now where you can invest in international funds, you can get exposure, offshore equity. So under liberalized remittance scheme, LRS, you're allowed to invest up to $250,000 every fiscal year in the offshore equity without taking any explicit approval from RBI. You can go beyond as well, but there are certain additional norms which are applicable. But up to $250,000 can be easily managed. You can invest in ADR and GDR. A lot of Indian companies have ADR and GDR exposure in the US, Infosys, HDFC, Tata Motors. The reason why people do invest in because the fluctuation in ADR and GDR is much more as compared to the US equity. So it is a great tool to trade, not essentially to invest, but it's a great trading tool to follow, right? There are offshore ETFs. So Mafang ETF, if someone heard about Mafang, right? It invests only in NASDAQ core stock like Nvidia, you have Broadcom, you have FANG stocks. So there are only 7 to 8 stocks where Mafang invests. Mafang has traditionally given phenomenal returns. So in last 6 months, it has given 40% return. Where Indian equity market is literally not given much return. Again, there's stock specific returns and so on. But Mafang has done, as an ETF, Mafang has done pretty well from an offshore ETF perspective. And again, you can easily invest because Mafang ETF is listed in India, so that can be easily invested from your Indian, demat account as well. But there are a lot of ETFs run by, Fidelity and Vanguard and so on, where you can easily go and invest up to $250,000 if you want an exposure. There are alternative investments, private equity, venture capital fund. Again, their exposures are available through the schemes which are run by. So for private equity, I think you need minimum 3 CR of investments. These are also they're kind of part of AIF, but there are certain SEBI norms applicable to them as well. And if you want me to talk about, I can do that. But so see broadly, again, just to talk about all this, the primary objective is that all of us understand what all tools are available for us to invest in different risk categories. It is subjective. We need to decide where we need to land up eventually 5 years, 10 years, 20 years, 30 years down the line. We need to decide how much risk we are ready to take in the market and what return it can give us. Even if you invest 100% of your fund in low risk investment, it is absolutely fine. Ultimately, it should give you a peaceful sleep at the end of the day. We should not sleep with worry, right? It should not happen that we are a risk averse human and we are going with all high risk investment. It will not, trust me, it will not work for you. It will totally depend on what profile personally works with you, right? If you have any questions, let me know. I have to leave, I have some commitments, I have to,
So you said for PMS, you need a 1 CR minimum.
PMS is 50 lakhs, AIF is 1 CR.
So that is the initial amount. Later on, we can do it in a smaller amount.
Since you want to, so PMS top up is allowed. Minimum top up is 5 lakh every time. You can do 5 lakh top up n number of times. AIF doesn't allow for any top up. AIF is a closed ended fund. So PMS is open ended. And they have the lock-ins as well. So AIF has lock-in of 5 years. And you can do an early withdrawal, but there are penalties for that. So if you want to withdraw in 2 years, there is 3% penalty. 3 years, 2% penalty. 4 years, 1% penalty. And 5th year, you can do free withdrawal. PMS, there is 1 year lock-in. And if you want to withdraw within 1 year, there is 2% penalty. At PMS, you can do top up n number of times. AIF, no top up. Yeah. Go ahead.
So there is one category of moderate risk that you have not put here, like your opinion. Thematic funds, do you suggest smart beta funds, momentum funds, alpha funds?
Absolutely. See, thematic funds are available in both mutual and ETF. No, that's a different category. So mutual fund can be categorized into various different categories, right? So thematic funds are available in large cap as well, in mid cap and small cap, in all categories. Now, absolutely thematic fund nowadays, they are actually getting a lot of attention because market from last couple of years have been doing a sectorial rotation. like so sometime back there was a defense rotation, before that there was a railway rotation, right? And that way thematic fund have given great returns if that particular sector is under rotation, right? That's but again, you know,
In the index also you have thematic funds, rather than the plain vanilla index, they are coming up with momentum 30 out of 200, 50 out of 500, 20 out of 50, hundreds of momentum funds they have come up with. Do they serve the purpose better than the underlying index, or do you think that the momentum funds are better?
see, I would not say this or that. I would say take exposure in both. You should have exposure in index, right? I said, and I shared this in investment group sometime back, that exactly last 1 year index has given nil return, right? From 29 July 24 to 29 July 25, index has been at the same level. So if you have invested in index, right? If you have taken ETF index exposure, you would not have earned a single penny out of it. But mutual funds, and depends on which category of mutual fund, some of the mutual funds have given 15% return as well, 15-20% return. Most of them have been subdued, but some of them have given good return. So again, you know, you should have exposure in both the ways. If you want to categorize between mutual fund and ETF, take exposure in 4 to 5 different funds. Have index exposure, have sectorial. If you are bullish about a particular sector, a lot of people are bullish about power and energy, a lot of them are about metal. People want to invest in commodities now because of the gold and silver rally. Take an exposure, it's okay.
We heard a lot about the buzzword SWP.
Sorry, what?
SWP.
SWP, systematic withdrawal plan.
Can you touch on that a bit?
Sure. See, so systematic withdrawal plan works with. So this is very similar to the. See again, it can be looked from two perspectives. Now, one is the retirement perspective. What people suggest. So what happens is that when you keep on investing in mutual funds or any moderate risk fund for 20-30 years, and you are in suppose need of fund, so they say that don't withdraw in one shot. Do a systematic withdrawal, like if you have a requirement of 1L per month. Do an SWP, so 1 lakh it will keep on withdrawing, but the remaining principal and the corpus what you have, it will keep on generating the return for you. So that 1 lakh will eventually come out of the return what you are generating. That is one way of seeing it in SWP. Second way of looking at SWP is the portfolio diversification. Right? So if you are only invested in equity, and my suggestion is you should not have 100% exposure in equity at all. You should have exposure real estate, agri asset, gold ETF, commodities, and everywhere. It has to be. Last session I took about diversification, so I am not touching about diversification right now. But a lot of people say that if you have got a good exposure in stock market, then do an SWP, withdraw a certain amount every month, and start diversifying so that eventually you will create a diversified portfolio as well. Rather than doing a one-shot withdrawal, because you don't know where the market is going to land up, right? Market might give you some better returns. So,
Can you put upfront like some 15-20 lakhs to start the withdrawal plan also, or is it only when we have those?
see, withdrawal plan would work once you have taken a decent exposure to stock market. I mean, for withdrawal plan to work, I would suggest you give 4 or 5 years of one investment in one particular product. Once you have earned a good return out of it, then the corpus will help you cover up your withdrawal plans.
The main purpose for the SWP is, okay, I reached to that certain amount, 1 CR, 2 CR, and now I need to live peacefully that I need 1 lakh, 1.5 lakh rupees every month, but I don't have to withdraw full 1.5 CR. Then I can put the SWP, okay, 1.5 lakhs only gone, but remaining amount still it's growing. So that way you can keep your investment also, and you can do your all the needs also in place of withdrawing.
See, it's also your your future expenses like your child education. If you see that in next 10 years, I would need say 10 lakh every year for my child education, or 30 lakh or 50 lakh, whatever. That way you can have SWP as a part of your arrangement. But for that, a corpus has to be established. It's very important.
From the starting only, if you are thinking of SWP, means you are clear you have need of money. So why to invest and again withdraw? Let it grow, make it big, then take the withdrawal, whatever you need. I think we'll go fast because we are already late.
You have a question, the last one.
The US follows a rule of 4% withdrawal for people retiring at 60. Let's say that's not the reality in India. I mean, we don't have the luxury say if someone wants to retire at 40, 45, I'm just giving an example. They say, let's say if you have 3 crores every year, you can withdraw 4% of that and live for 30 years. Basing that the inflation is 4% or in US inflation is obviously lower. So they have to make it 4%, for us it can be 3% also, withdrawal rate, but that applies at the age of 60 because they have assumed that 30 years living life and all. But let's say if your living life is 45 years, assume the lifespan is higher these days, you're starting at 40-45 retirement and you're living for 30-35 years. What do you think should be an ideal withdrawal rate or a corpus that helps us build that?
See, it is very subjective, right? It would depend on what expenses you foresee. There was a study on retirement, and I don't completely agree to it, but anyways, let me just share the outcome with you. Someone has given a number of 7 CR to retire at the age of 45, and this is assuming there were a lot of assumptions, and so there were 2 kids. Both of them have not reached teenage, right? And there was the house was. So again, suppose no. So I'm kind of coming to that. Now, if I set a number of 7 CR at the age of 45 for you to retire, right? Now again, your monthly expenses would be, ideally it should not cross more than 2 lakh per month. That is what the criteria they usually they would follow. But it would totally depends on education and health inflation is highest in India and that in global, right? It is very difficult to foresee how much expenses you're going to run in next 20 years, assuming you're retiring at the age of 45 and your kids are still less than 10-year-old or whatever, single digit of age. So there are a lot of sheets which are available for you to do the calculations, but you may not agree to these calculations because it is difficult to foresee the way Indian numbers are working out. See, US is a developed economy. They can foresee a lot of projections and numbers. For them, it is a very stable growth everywhere. Be it inflation, be it salary growth, be it your retirement expenses, so on. And they have a great social security program as well, which will protect them from a lot of things. India doesn't work that way.
Maybe he will share some details with you.
I ask this question because the numbers are scary. For a very small amount of, let's say if you need 1 lakh, the numbers are at 7 crore, 8 crore. I mean, it's kind of a catch-22 situation. I think we have 8 crores at 45, giving for a 1 lakh for the rest of the
No, that's what people are, that is the people are not able to retire, right? Yeah. I mean, if all of us are able to have a corpus of 7 CR at the age of 45, then most of us will stop earning that when we'll live a happy. So that's where the numbers are scary for sure, and this is because, like I said, the education and health inflation is very high in India, right? So you need to account for 10 to 15% of increase in education pricing every year. And for your kids, assuming you have no kids and you just want to live by yourself, then the numbers will be completely different because a lot of them incorporate your expenses, what you're going to have out of it.
We have a standard living, that's one.
Yeah. I mean, it is quite a discussion.
Later.
Yeah.
We will share the more details in the group.
Sure.
Because we have 1 o'clock another session, I think that one. So we'll take just 15-20 minutes.
Right. Okay. So thank you very much. I mean, if any of us want to discuss about investment with me, I kind of work 3 times a day and I see every one of you, most of you, so you can discuss. We can talk about in detail, right? Okay. Thank you very much.
Thank you very much, Atul. So I will not go in detail with this because Atul has already covered. But stocks, mutual funds, bond, especially for the stocks, we always feel that is not my area. But don't look at that way. You can explore, you can learn. There are multiple things in the stock market also that you can do the fundamental analysis study. If you are good in knowing the balance sheets or something, some numbers, ratios and all. Otherwise, technical analysis if you are doing the tradings and all. But don't go for, there is no shortcut for the money. Just understand simple principle. If someone is giving you the tip and telling you me just 2,000 rupees per month and you will put in the F&O and you will become rich. If you are going to become rich, why he is just worried for 2,000 rupees? He will take a loan of 1 CR, he will put his money and become 100 CR. Why? So don't fall in the trap. There are multiple sources, Telegram channels and all. No. If you are really interested to learn the stock market or mutual fund, explore. YouTube have multiple things. You can go in deep, take some course if you need to really go in technical analysis, advanced technical analysis. F&O for now, futures and options. it looks very lucrative for the youngsters. Okay, market gives you the good luck at the starting. Your money 30,000 will become 1.5 lakh. You will see, wow, I will leave my job and I will do this. One day it will become 5 lakh rupees. But that 5 lakhs when you will lose in 1 week, you will only not realize. Then you will use your credit card. It's addiction. So F&O, unless you have the knowledge and unless you are confident, don't at all look at to that field. There are multiple other options to create the wealth. Keep it mutual fund, keep it stocks, equity. In Nifty 50, so good stocks. I know Reliance is good. Or Nifty 50 stocks means good 50 stocks of India. Take one stock from IT, take one stock from chemical sector, anything like suppose HUL or Britannia, something I know. I am regularly using the Ashirwad data, ITC or ITC. So many products I am using. So in regular life also you can judge the stocks which I am using. But I know the quality is good from long and they are really making it good. So I know this company will stay longer. So keep invested for longer. If you are not knowing the stock market, also no need to worry. The mutual fund managers, they are paying their fees, whatever 1%, 0.5%. It's because they are knowledgeable. Let them do their work. You just put small money and live peacefully. The main thing what Atul has also told important is diversification of your investment. Don't just go 100% in real estate. I am buying one flat in Mirabilis, C tower, F tower, everywhere. What if tomorrow in Bangalore, it should not happen, that should. There is no water. Tankers also, no one can supply. What will happen? From the peak, it will go down. So keep your exposure in all the different areas. Like real estate is also good. Gold, silver is also good. You can put mutual funds. No need to keep everything 100% portfolio only in stocks. What if stocks market today is 24,500? It can become 20,000 because it went up only, right, from 7. For long term, it never happened that it is stuck to the 7,000 only from 20,000. Long term, it will go up only. So think long term. That is the main purpose and keep diversification. You can keep 20, 25% in different things. Depend on your exposure, which Atul has told. If you are a youngster, you can take a risk. Suppose at the age of 50, 55, you can. Okay, I know that I cannot take the risk to putting all in the equity or something. Then I will see about SWP plans or some mutual fund which is little low risk, like large cap or blue chip fund. I know this company grows by 15-14% CAGR. I am happy with that. I don't need 30%. At the end, for long term, no one gives like 30%, 40% CAGR. If you see any mutual fund, 1 year it might be giving 30, 34%, 35%. If you see for long term, for 5 years and all, it is 14, 15%, 18% max. No one can tell you that I will make a magic and give 50% CAGR. No. Maybe I will take question at the end. This is just I have added the VPF, especially for the job, whoever is doing the IT jobs or anything. VPF is also one option where it's your PF account only. So you will increase your contribution. Company will not increase because company is already putting the money. But if you start at the age of 23, 24, some 1,000, I increase every year 1,000 rupees. You don't have to worry. I don't know about anything about investment. Okay, no problem. Let's start VPF. Your PF will grow. It's the same account. It will happen compounding. Once it becomes 30, 40 lakhs, 50 lakhs, every year 8.25% interest will come. That will get added. It's compounded. So when it will become 1 CR at the age of 15 years, after 23 to 15, suppose 38, 40 years, at 1 CR to 2 CR, just 5, 6 years. And you don't have to worry that because what happens, if money comes to our account, we will spend. In this case, HR only will deduct from your salary. In place of 1 lakh rupees, you will get 90,000 salary because 10,000 you added in VPF. It will keep on going and it will accumulate. That's what I am telling the power of compounding. I have just added the ones. So PPF, VPF, suppose PPF and VPF is around same. PPF is you can take your provident fund account, PPF, personal provident fund, public provident fund, where it is interest rate is little less, lock-in is there for 15 years and all. Both are having the tax advantage. So continue at least with VPF. If you are new joiner, if you are already in the stock market, SIP and all, this might be not the thing that you can start with, but you can keep. As Atul told, we should have the diversification. We should not have exposure that everything will crash and I will worry that what happened to my 1 CR it was, now it is 45 lakhs. What 55 lakhs? No need to worry like that. So mutual fund also just I have added, Atul has covered. So in the mutual fund, one point I will tell you, the direct and regular. most of the time we are so lazy, means we don't even know previously. We'll take a mutual fund SIP from either ICICI Direct, HDFC Securities or Zerodha. They will give us a fund like Parag Parikh Flexi Cap. Parag Parikh Flexi Cap, regular growth fund, normally in our account. But there, if you buy directly from the Parag Parikh Flexi Cap, Parag Parikh side, there are direct funds. Because if you buy from ICICI Direct or Grow or anywhere, they will have their percentage, they are managing, they are giving you that service. It's not free. So when your investment will become too big, the direct fund, if you buy directly from the Parag Parikh website or HDFC, I need to buy HDFC mid cap fund. Why I should go to the Zerodha? I will go to HDFC. It's just a PAN card, create your login, start SIP, select HDFC mid cap direct fund. Whichever fund you are having, just do Google, after going home, just do Google Parag Parikh Flexi Cap, growth fund and direct fund. NAV, there is a difference. You know, right? NAV, because we get in units. So, if the direct fund NAV will be always higher by 2 or 3 or 5, long term it might be big. So, when your investment becomes big for 15-20 years, it makes a difference of 2 lakhs, 3 lakhs rupees difference. So, why to worry? Just problem is that we cannot see your investment at one goal. It's not like one portal I am able to see my 4 investments and all. It's different 4 accounts, but why to worry? Mutual fund is for long term. No need to check every day mobile and check my mutual fund what happens. So you can explore the direct fund option also, which will give us advantage that we will get a benefit that charges will reduce because that 0.5, 0.2% makes a huge difference when it becomes 1 CR or 70 lakhs, 80 lakhs and all. So just added this point, but Atul has already covered the power of compounding. Let it grow. Let your investment grow unless it's needed. Okay, here I just put the sample, just compound interest calculation only. You don't have to worry to become 2 CR. For now, 2 CR might be big for us. Just invest 10,000 rupees. I added 10,000 rupees every month for 25 years. 10% only I put. Mutual fund normally 10 to 15% you will get the CAGR. Let it go. It's because it's a 25 years. So investment is 2 CR. Just my message to you is not to reach 2 CR or 1 CR and all. But CR is also possible. Normally the middleman or we think that oh no, they are just talking about numbers. But it's possible. Let it continue your investment. Every year increase by 1,000 rupees, 500 rupees. So, okay. Another important topic is term insurance. Most of us, who all are having term insurance here? Maybe Ashwin don't feel that it's important. I am giving my example also. Because what is there for me? Nothing. It's wastage of money. I am not getting any return. I always think about investment. But no. Why term insurance is important? Now life is so uncertain. I am not telling it we should get the money from term insurance. But now we are taking loans. We have to pay the EMIs. Our kids' education, they have to grow. Here, big and or 2.5 lakhs. Next year it will be 2.8 lakhs.